Hello, everyone. It's Tuesday, November 22nd. Today, we have one of the best, Ari Wald from Oppenheimer, joining us from New York. We'll see what charts tell him how to think about the next couple weeks and into the new year. The S&P, the major averages, having a decent update with the S&P closing above 4,000. Ladies and gentlemen, this is the final bar. Hello, everyone. Happy Tuesday. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The Technical Analysis Toolkit is designed to help us navigate the markets by focusing on the message the markets provide back to us. Great academic research over the last couple decades has shown that there is information embedded in price. This is why the momentum factor is a thing that we can talk about. If you Google momentum factor, you'll find all sorts of evidence about trend following and why analyzing stock trends has value in predicting their next steps. We try to apply that day-to-day, real-time in the markets and focus on what we learned every day, trying to analyze the markets using the technical toolkit. We appreciate you joining us on this ride. Excited to talk to Ari Wald here in a short while, see what charts he's looking at. He has some great historical studies about where we're at in the markets right now, what it might mean. When we've talked about this rally phase, a day like today, it's hard to draw a lot of hard conclusions on a day like this, and I'll tell you why. We are entering into that holiday sort of break. The next couple of days, usually lighter volume, usually net positive. So I would be amazed if a week like this does not dribble to the upside in any environment. The real questions most likely will be answered next week. But let's see what we saw today, because some important breakouts to update you on. Great guest today, as I mentioned, Ari Wald from Oppenheimer. As a reminder, we'll be taking the rest of the week off, celebrating Thanksgiving with our families. So wish you guys a very safe and happy Thanksgiving holiday. We'll be back with you next week on Monday, the 28th. 3 guests lined up for you on Tuesday, the 29th. Steve Bigelow. Steve's a candlestick expert. We've not had a lot of those on the show, so I'm excited to see what sort of charts he's looking at. Javed Mirza from Canaccord Genuity in Toronto will be in on November 30th. And then Thursday, December 1st, Mitch Schneider from Market Gauge in New Mexico will be joining us on the show once again. Let's continue on our show today with our market recaps. I mentioned decent update for the major equity averages. Let's look at the charts and see what actually played out through the course of trading today. The S&P 500, as I mentioned, closing just above 4,000. That might be an important number to watch. We've talked about how that's a sort of a confluence of Fibonacci levels. We'll bring up that chart here in a moment, but we've referred to it very often recently, particularly as the market has rallied off the October lows. We're kind of getting to what I would describe as a natural point of resistance, right? A confluence of levels where you'd expect resistance to happen. And the question is, do we power through these levels, indicating an influx of additional buying power, a sign that we are not exhausted with the uptrend and that there's further upside to be had? Or do we stall out here? Has this been the run and we stall out at expected resistance? I think those questions most likely answered into next week. But the S&P closing just above 4,000, that's up about 1.33% from yesterday's close. About the same gain for the NASDAQ Composite. NASDAQ 100 was up about 1.5%. Mid caps and small caps both up as well. Mid caps the best performing of all three, and the VIX moving lower, ever lower toward that 20 level. And again, I think what's really, not that this is ever easy, but a lot of times there are a lot of question marks when you look at the markets. A lot of times it feels like you have a pretty good game plan, or at least that's how I feel, right? You have some key levels to watch. You have some key indications, and we're sort of right at that point. So it feels like we'll get a lot more clarity here very, very soon. The VIX is getting down to 20. And as we've talked about a number of times, the VIX has pulled back to 20, I think 3 times in 2022. Every one of those times so far has been a pretty tradable top. We're kind of getting right now to that level. So we're approaching price resistance as volatility gets to the place it's been for previous tops. Does that indicate a short-term top? Again, I will wait for the markets to confirm that by rotating lower, and we didn't see that for sure today. Bonds also moving higher. The TLT was up about 1.4% as interest rates came off today. 10-year yields came down from around 382 yesterday to around 375 today. It's obviously well down from 4.25, which was the high earlier this year. Dollar index also moving lower. So in a lot of days, a lot of weeks in 2022, you've seen the dollar up and kind of everything else down. That's why we kept calling the dollar the wrecking ball for risk assets. You get the opposite on a day like today, with the dollar weaker, the dollar lower, and stocks and bonds both actually moving to the upside. Also, some strength in general in the commodity space. Gold not up a whole lot. The GLD was up about 0.1%. Silver up a little bit more, and energy prices moving higher. The XLE, as we'll talk about here in a few moments, the best performing out of the 11 sectors. A lot of green on the page of cryptocurrencies, which is not a sentence I've uttered much in the last couple of weeks, but you're certainly seeing it today with Bitcoin up about 2%, Ether up about 1.6%, Bitcoin pushing back above 16,000. That's after dipping below there during yesterday's 24-hour session. So sort of pushing back to the upside overall, but still a lot to prove, certainly before those charts look constructive. When we look at a daily chart of the S&P 500, I think this summarizes why we're at such an important level. These horizontal lines, and I know this chart is pretty busy, I tend to think of my charts as a conversation, an ongoing conversation you have with the markets, or an ongoing dialogue you have with the markets. And the lines that you draw, the notes that you make, are that conversation you're having, trying to understand what's going on, trying to think about the supply and demand, the fear and the greed, and all the evidence that you can see on the chart. So the charts I show on the show are actually as whitewashed as I can. I'm limiting the noise on there just to try to make sure that I can show you good examples. But the charts I use in my own work tend to be a lot more cluttered with thoughts and ideas and indications of what I'm seeing, because when you look back, you get basically a visual record of what you were thinking and what you were seeing at different points, which can be a really helpful, informative exercise if you can go back and review it at year end. So the 4,000 level is important because it's what I'd call a confluence of resistance. 4,000 represents 61.8% of the way back up. If you take the August high to the October low, we're kind of right there. That's been the basically the high for the last couple of weeks. After that gap higher, this was that Thursday a couple of weeks ago. Then we sort of had the Friday higher. From there, we've been sort of stabilizing around this level. We're kind of right back to 4,000. 4,000 also represents a 38.2% retracement of the way back up, all the way up to the January high. So Jan 22 to October 22, 38.2% of the way up is right about that same level. So anytime you have kind of a confluence of levels all focusing at the same point, I think that can be pretty compelling. Now, a little bit above current levels, we have the 200-day moving average around 40.60. We have a trend line. If you have a log scale chart, which we are showing here, you take the highs from January, from March, and from August, they line up to around 4,100. So between 4,000 and 4,100, we have a lot of indications suggesting that's most likely where you'd expect a bear market rally to exhaust, which means this is the question that needs to be answered. If this is a bear market rally, we're kind of near the exhaustion point. You start to see rotation lower. The bearish divergence that you see on a chart like Netflix actually follows through, and those stocks break down. Stocks that are breaking out sort of fizzle out. You start to see failed breakouts. That would indicate a most likely rotation lower. The other option is we finally get this question answered, and I would say with authority. We get above 4,100. I would not be very comfortable labeling this a bear market rally anymore, and you have to start talking about it maybe in another label, at the very least, a meaningful recovery with upside potential. And you have to think about some of the upside targets through year end and maybe into the new year. So really at an interesting confluence of levels for the S&P 500, a lot to watch and a lot to pay attention to going forward. Just to finish off with our market recap, as I mentioned, the energy sector, the best performer, up 3.1%. I was talking with a CMT candidate. I'm sponsoring someone for their CMT level 3, getting their full designation, which is always a really exciting end to a challenging road of studying the best practices of technical analysis. We were talking this morning about how energy has often been the best performer or the worst performer. Hasn't been a lot of days where energy has been kind of in the middle. It's been sort of at the top or the bottom. It shows you the volatility in that space. But overall, I've seen way more at the top of the list than the bottom of the list. A lot of energy stocks not far off of 52-week highs. Materials, number 2, and then technology and communication services right after that. What was underperforming? Everything was up, but real estate was up about 0.5%. Consumer staples, industrials, both up about 0.75%. We have to wrap and go on to our break, but I would highlight some of the names on the move. We've had some interesting earnings names this week and a lot of gaps. BBY, Best Buy, Agilent Technologies in the healthcare sector, two stocks to look at with some nice gaps higher today. Let's take a quick commercial break. We'll be back with Ari Wald from Oppenheimer. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close. It's a blast to do this show every trading day. We will miss you for the next couple days, but I'll be happily celebrating Thanksgiving with my family, and we'll see you next week. Couple quick announcements before we bring on today's guest, Ari Wald. First off, we are here for your questions. We'll do a mailbag a little later in today's show, answering some of the questions you guys have sent in the last couple of days. We'll do another one Tuesday of next week. You can get your questions to us via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, and on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air next week. Also, go to StockChartsTV.com. I was reviewing a couple recent videos. Bruce Frazier had a really fascinating video from his regular show. Larry Williams had his most recent market update video that he posted over the last couple of days. All of that content and some fantastic guest interviews are all available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Ari Wald. Ari's from Oppenheimer in New York, has been a frequent guest on StockCharts TV and on our show. Ari, great to see you. Welcome back.
Hey, always a pleasure, Dave. Thanks for having me back. Really appreciate it.
So this has been a fascinating year. I've really appreciated our conversations. You always help us sort of stretch our thinking and try to put things in context. Talk to us about this bear market and what you're seeing right now.
Yeah, I'm going to try to answer your question. Bear market rally, new bull market, and we're siding with new bull market. And here's why. Let's first look back at where the market has been. And what we're showing here is every bear market cycle in the S&P 500 since 1950. So this year, the S&P was down 28% over a 9-month period. And we want to make the point that this captures 80% or so of the bear cycles through history. This was likely it. What we found is that if you're expecting something of deeper magnitude than what we've seen this year, typically is going to be a shorter decline, 1987, 2020, examples of that. If you're expecting something longer than the 9 months that we've seen, many of those drops were shallower than what we've seen, that this was pretty deep for a 9-month drop. That conversely, the outliers, that we've only found 4 down cycles that were both long and deep. The 2 in the 1970s and the 2 in the 2000s. And the point we want to make is that those were outliers. Those were not run-of-the-mill drops. We'd also argue market conditions stronger now than they were then. I'd argue that credit is stronger than it was in 2008. I'd argue we haven't seen the price appreciation we saw in the late 1990s. Why should we expect a bubble-like collapse without bubble-like returns? And even in terms of the comparisons to the inflationary 1970s, we'd argue the market is now tracking closer to the late 70s rather than the early 70s, given the Fed's commitment to fight inflation. By the late 70s rolled around, the market was already starting to rally, even against tighter monetary policy. So for all these reasons, we think we've seen the bear cycle. And now that the market, as we're starting to see this base develop, is positioned to break out to the upside.
It's such an interesting piece of work, and I really appreciate it, Ari, particularly thinking about the average sort of, downtrend within this period. And based on that analysis, it seems like we're sort of past the normal bear market cycle in this sort of environment. Your second chart, by the way, was a really interesting one. This is a longer-term chart, a monthly chart, but using a ratio we often refer to, consumer discretionary versus consumer staples. Can you talk us through this one?
Of course. So this is not only have we seen these washout conditions, now our indicators are improving as well, specifically indications of the right leadership, if you will. And to measure this, I'm looking specifically at the relative ratio of the consumer discretionary versus consumer staple sector on an equal weighted basis to, again, capture the relative leadership between risk on and risk off as measured by these two consumer sectors. And what we're showing is that after this big drop in risk, significant drop, we're now starting to see a turn higher in this ratio from the lower end of what the range that it has been in for much of the last decade, the lower end of its decade-long range. Again, why we think we're starting to see improvement and why we think this strength is just emerging as well and has why this upside has some legs to it.
I love this. I love the long-term nature of this chart. And I've often been telling people, if your runway's long enough, it feels like trying to, get cute about where the bottom is really doesn't matter a ton. Right? I mean, if your runway's long enough, there it just seems to be a good risk reward kind of opportunity. As you're looking forward, Ari, through year end and really into the first quarter, we're obviously dealing with the Fed and most likely future rate hikes. But a lot of individual charts, a lot of sectors are actually looking just fine. Where are you looking for opportunities if we are, in a period where we should be starting to get on offense? Where do you place your bets in this kind of environment?
Yeah, such a great point. It's the right leadership, and you're seeing breadth improve meaningfully, specifically on that final leg lower in the S&P. A lot of breadth gauges improved significantly, and it's in areas like industrials and financials, risk on areas as well as obviously we're showing consumer discretionary here. Obviously, energy has maintained its leadership too. So I think the two standouts would be industrials and financial as far as new leadership. Areas that started to break out during the summer, they held up well during the Q3 slide and have maintained their leadership on the October turn. So I think, again, I heard your intro about the momentum factor. That's where we're seeing momentum in markets, which has been an alpha generating strategy that is really we're big advocates for. And at the same time, I wouldn't give up on technology either. I mean, that's obviously been the sector that has been most correlated to Fed policy and has been pressured the most during this rise in rates. But I do think that we could be at a point where even tech joins the upside move here, and we can get to a point in this what is still a secular bull market where both growth and value work together, but specifically the offensive sides of those pockets of the market.
I love it. We'll call it the FIT strategy: financials, industrials, technology. We'll go with that area. Listen, awesome to chat with you as always. Thanks for some really good long-term charts. Have a fantastic Thanksgiving. We'll talk to you again soon.
You as well, Dave. Take care. I'll talk to you later. Bye.
That's Ari Wald. There's the chief technical analyst at Oppenheimer Investments coming to us from New York. I love the long-term charts and what I really appreciated about what he said, particularly with that ratio. We look at that ratio, consumer discretionary versus consumer staples, often, but we usually are doing it on a much shorter time frame. We're thinking about day to day, week to week. When you think about the long-term trends, that's where you really understand more of the secular shifts, right? As ideas and as themes, as risk appetite sort of fluctuates and cycles from positive to negative. Certainly some charts that have made me think. They're great take as always from my Ari Wald from Oppenheimer. Let's continue on our show today with the Final Bar Mailbag. As a reminder, the mailbag always open for your questions. The Final Bar at StockCharts.com is the best way to get your questions to us. And let's go to question number one. Dave, based on the S&P 500 year to date, what other years does this look similar to? And based on that, what previous year will look most like 2023? I love your question so much, and I really appreciate you sharing that with me. It's such an interesting question, and the short answer is I don't know. And anyone that tells you they do know is lying to you or lying to themselves, because none of us know. But what I would tell you, it is really informative. It's really helpful to do this sort of constructive thinking. Start to look at historical periods. I had not thought about the late 70s a ton until my guest today, Ari Wald, mentioned it. That's actually an interesting kind of analog that I've not looked at a whole lot, and I will absolutely start to do that. If you'd asked me for most of this year, what does this most feel like? To be honest with you, I would have said 2008. And I still don't know if we're completely clear of that. Ari's certainly much more constructive than I am. I'm a little more bearish overall structurally on the markets. I think there's more downside to be had. However, again, I think where he and I both agree is that the markets will give us the evidence we need, right? It'll tell us which side is correct and give us time to make sure we allocate effectively. But what concerns me about the market in 2022 is it looks a lot like the middle of 2007 to the middle of 2008. Now, what happened soon after that in 2008 is that you had a waterfall decline, right? Things really started to accelerate to the downside. Now, that obviously was the financial crisis. Things were starting to unwind, and then they really got bad there in the middle of 2008. there would have to be some catalyst, right, that was significant to accelerate, right? So if you look, it's been sort of a gentle downtrend by historical standards. That's kind of what it looks like there. It also looks like the beginning of 2000. The 2001, 2002 was marked by a continuation of that general pace. 2008 sort of accelerated. So there would need to be some catalyst. And the good news is I think the market will indicate if that's sort of what's playing out. So I don't think I can't say we're going to have another 2009 sort of sell-off. So I don't know if I would make that sort of claim. So what would I sort of say? I'm going to do this deep thinking on this in about a month. This is something I tend to do at the end of the calendar year when I'm reflecting back on the year and looking forward to the next year. So probably tune into the final bar at the beginning of 2023, and I'll give you a general idea of where I could see this market going. But I would say right now, 2022 looks a lot like that historical period. That's what it most reminds me of, at least during my career since 2000. I think going back to some of those 70s and 80s periods might be of interest as well to see if there's a good historical analog. What might next year look like? I would probably start to think it's going to be one of those years where you have a drawdown in the first quarter, and then you start to improve from there. I'm almost seeing it's like a 2016 kind of year. That's probably where I'm generally thinking, because I think the first half of the year is where we digest. We have that next big move lower as we digest what the Fed is going to have to do to contain inflation. I think it's going to be longer and more painful than a lot of people expect. But then from there, we've reset to the point where we probably have a lot of upside. So that probably would be my initial guess. But I'll have to do some more thought on that. That's a meaty question for the mailbags. That's as well as I can do in 3 minutes. I'll do some more thinking on that and give me some time to do a deeper dive. Next question. I think this is the beginning of the fifth wave higher for the US dollar. Would you agree? Really interesting question. Let's bring that up. So $USD is the dollar index. We also have the UUP, which is a bullish dollar ETF, which we often track. You didn't include a chart, so I can only assume, looking at the chart of the dollar, I would guess what you're implying is that the low in 2021 was a pretty significant low, right? That was sort of a bottoming pattern in the dollar. You then have wave one here, wave two to May 21, and this is a big wave three. I guess that's possible. And then you would have wave four, and then you have a wave five, which kind of comes up to the upside. It's an interesting idea. I'm not an Elliott wave or an Elliottian, Elliott waver, whatever we would call it. I'm familiar with it, and I had to study it for the CMT exams, as most of us did. But it's not something I use in my main day-to-day work. What strikes me about that, I don't know if that would be the best count because the wave three is so disproportional to wave one and wave five. But I'll ask the next Elliott expert that I talk to. I'll sort of pose this chart and see what they will tell me, and I'll share what they would share. But if it is, and if that's true, then often wave one and wave five are very similar, which means wave one is like this, which means wave five kind of gets us a little bit above the September high, but not much further. But what that would tell you, if that's true, is that this is going to be a painful leg for equities, most likely, right? Because the story of 2022 has been stronger dollar, higher rates, weaker risk assets, basically weaker bonds and weaker stocks. If that would happen, it would be very difficult for the bull market that Ari was talking about to really be positive, right? Or really be possible. The dollar being that strong would make that pretty powerful. I would say, what would tell me about the dollar? I think it's this support level here. Just like the S&P is testing the 200-day from below, testing a trend line from below, flip that over. And I think that's kind of what the dollar index is doing. I use less Elliott wave, and I'm more of a trend follower, which means I would want to see a level be broken 38.2% of the way down from May 21, which was sort of the beginning of this big wave three, as I think you would label it, to the September 22 high. 38.2% of the way down is right where we bottomed out about a week ago. We break below the 200-day. That's where the dollar really weakens. But other than that, I'm assuming stronger dollar from here because we've pulled back to a key support level. Next question. First Solar FSLR is at 99.9 in its scooter ranking. Is it possible theoretically to reach 100? Really interesting question. The short answer is no. So the way that our scooter rankings work, it's a percentile ranking system, and it goes from basically 0.1 all the way up to 99.9. So 99.9 is essentially the top ranked stock in whatever universe. I bring this up on the dashboard often, and you can see we have the universes: large cap, mid cap, small cap. We have another scooter ranking system just for ETFs, and it's a whole bunch of different asset classes covered there. The Dow industry groups, which can be really helpful as well. And then we have Canada, London, India, all covered as well. We have their own scooter rankings for each of those markets. What that means is you can bring up something like industries, and you can click on where you can switch there, and you can actually see which industries score the best. So renewable energy equipment, the top ranked industry in our scooter rankings, because again, it's ranked 99.9. You can actually bring up any chart list, any group of ETFs or stocks or industries and put them in there. You can sort them based on their scooter rankings. It's a great way to order any list from strength to weakness based on conventional analysis and conventional techniques, quantifying trend following. Great questions all, but we have to wrap the show and go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the materials sector. If I remember, I was jotting it down as Ari was saying, we went with the fit stocks: financials, industrials, technology. Those are the 3 that he mentioned. I like materials here. That's one that Ari didn't mention, but I think there's been a nice improvement in the materials sector. Some steel names, things like Nucor, come to mind with a nice rotation higher, but also in the gold and precious metals, right? The XAU is an interesting chart. It's kind of rotating higher. The XLB is back above its 200-day moving average, and just this week pulling back and then finishing in a position of strength, heading right back up to that 82. I'd like to see it get through there, but I like the fact that we're above the August highs. Looking at which charts are above their August highs versus which ones are not can be kind of an interesting analysis to see which charts are recovering their previous highs and which ones still have more to prove. So the materials sector improving on a price basis, but also on a relative basis. Chart number 2, as I mentioned, gold and precious metals. This is the XAU, the gold and silver index. I like this because it's a great illustration of a rotation from distribution phase to accumulation phase. Those are adjectives that I throw out to describe price dynamics. A distribution phase, in my mind, is when you have lower lows and lower highs, sort of a Dow theory downtrend. I would call a consolidation phase where you have sort of this equilibrium, right? You bounce around, but you don't really make any directional movements. We're kind of sitting on some of the key moving averages a lot of times here. But then when you see a rotation higher, you go from lower highs to higher highs. You go from lower lows to higher lows. That's a rotation to what I'd call the accumulation phase. So I like the fact that the XAU is making higher highs and higher lows. This week, we had a bit of an island reversal, a gap lower, chopping around a couple days and a gap higher. That's a bullish sign as well. Getting above the 200-day would be a nice follow through for the gold and silver index going into next week. And I like the fact also that the relative strength is improving on the RSI, and also the relative strength close to making a new 6-month high. Finally, Agilent Technologies, I mentioned in healthcare. This is one of the top gainers in the S&P 500 today. Another chart just rotating beautifully. One of the things I remind my own clients at Market Misbehavior, it is always a good time to own good charts. And a chart like Agilent, we've talked about previously because it's rotated. It's rotated from a downtrend phase to an uptrend phase. The momentum is improving. The relative strength is improving. It's gapped higher today, but that's after 6 months of consistently outperforming the major indexes. Focus on relative strength to find those names and those charts that are working. I like the gap above 150. Holding that would be really important as we go into continue this holiday week. Folks, that is a wrap for the show and a wrap for this week for the final bar. We'll be taking the next couple of days off for Thanksgiving. Wish you guys all a very safe and healthy Thanksgiving holiday. Also, it's my mom's birthday, so happy birthday, Mom. My parents are jumping on the plane in Cleveland and flying out here to Seattle to visit us for Thanksgiving, so cannot wait to see them. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great holiday. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.